The S&P 500 just punched through 7,000 on the same day gold hit $5,300 and silver ripped past $115. That combination is not bullish. It's not confidence. It's a structural warning that the pricing system itself is bending. Because in normal markets, those assets do not celebrate together. Stocks are supposed to represent growth. Gold is supposed to represent fear. When they both go vertical at the same time, the market is telling you something darker. It's not the numerator that's getting stronger. It's the denominator that's getting weaker. And if you're watching this while you argue about which milk is in your coffee, I need you to stop. Not because coffee matters, because you're living through the kind of transition where 6 months from now, the real question won't be oat or almond. It'll be, can I afford it at all? Stay with me, because later in this video, I'm going to explain the one mechanism most people miss when they look at a melt-up like this. It's not greed. It's not even optimism. It's a forced behavioral shift that happens when an entire public realizes cash is a melting ice cube. And when you see that mechanism clearly, you'll understand why today's green screens are not a victory lap. They're a symptom. Welcome back to the Dollar Watch. We track the hidden economy, the plumbing, the incentives, the corruption, and the systemic risk that mainstream coverage either can't explain or won't touch. Let's start with the why behind the impossible scoreboard. The United States has trained you to interpret the S&P 500 as a report card on the economy. That's how it's marketed. That's how politicians weaponize it. But the S&P is not a GDP meter. It's a pricing mechanism for financial assets denominated in dollars. If the dollar loses purchasing power, the S&P can rise even if the underlying economy is deteriorating. That's not ideology. That's arithmetic. This is why you can have a nation where grocery bills explode, housing becomes unattainable, and wage growth can't keep pace, while the stock index makes new highs. Nominal gains can mask real losses. The market can be up while you're poorer, and the fastest way to get trapped is to confuse nominal performance with real purchasing power. Now layer in gold at $5,300. Gold is not just a commodity. Gold is a referendum on the credibility of policy. It's a lie detector for central banking. If the world genuinely believed the economy was stable, the debt was manageable, and the currency was sound, gold would not be screaming to all-time highs. People don't buy fire insurance when the building is fireproof. They buy it when they smell smoke. So what does it mean when the S&P is euphoric and gold is terrified at the exact same time? It means we've entered the phase where markets are pricing two realities simultaneously. One is the political narrative. The other is the monetary reality. And that brings us to the most important framework for today, the crack-up boom. The phrase comes from the Austrian economist Ludwig von Mises. It describes the terminal psychology of a fiat currency when the public stops treating money as a stable store of value and starts treating it like a liability. In that phase, people don't buy assets because they love assets. They buy assets because they hate cash. They don't want to invest. They want to escape. Historically, crack-up booms are not polite. They don't look like steady inflation. They look like mania. They look like everything going up at once. Stocks, real estate, art, collectibles, gold, silver, anything that feels more durable than the currency itself. And here's the part that traps smart people. It can feel like prosperity. It can look like wealth. It can even produce real winners. But underneath, the system is hollowing out. If you want a brutal historical reference, look at Weimar Germany. There were moments when paper wealth exploded. Stock prices rose dramatically in nominal terms. People who held hard assets looked like geniuses until they realized the profit was simply the currency collapsing. In those environments, the question is never, did my portfolio go up? The question is, what can my portfolio buy? Now, to be clear, the United States is not Weimar in a one-to-one sense. Different institutions, different reserve status, different capital markets. But the mechanism rhymes because the mechanism is human behavior reacting to monetary debasement. When the public believes the authorities will choose inflation over default, and almost every modern government does, You get a collective sprint out of cash and into things. That's why today's rally is not comforting. It's coherent, and it's dangerous. Because politicians love the optics of a soaring stock market. It gives them a headline. It gives them a talking point. It gives them a tweet. But a soaring stock market driven by currency decay is not a win. It's a silent tax. It is purchasing power being confiscated in slow motion. And there's a supreme irony here. A weaker dollar has been openly advocated by certain political factions for years, usually framed as a competitiveness strategy. A cheap currency makes exports cheaper for foreigners. It can support domestic manufacturing, at least in theory. But the side effect of a cheap currency is import inflation, and the United States imports everything that matters to modern life: electronics, industrial components, consumer goods, and above all, energy inputs embedded in global supply chains. So yes, you can get an index at 7,000. You can get a victory lap. But you can also get a working class that feels the noose tightening because the cost of living reprices faster than wages. This is how social stability erodes, not in one dramatic collapse, in a relentless grind where the official story says booming and your receipts say dying. Now we need to talk about silver, because silver is where the system shows its cracks first. Silver is not just a monetary metal, it is an industrial necessity. It is used in solar photovoltaics, high-reliability electronics, medical applications, advanced batteries, connectors, switches, and defense systems. If you want to build the electrified future that policymakers keep promising, EVs, grid upgrades, data centers, AI infrastructure, you need silver. Not a little, a lot. And here's an open loop you need to keep in mind. The most alarming part of this story is not silver at 115s. It's the possibility that the posted price is becoming a theoretical concept because the metal itself is no longer flowing through the official channels. We'll get to the Shanghai blackout reports in a moment, and then I'm going to show you why the Western retail market is freezing at the exact moment the screens are screaming higher. That contradiction is the signature of a liquidity crisis. Let's go east first. The reports coming out of China, specifically the manufacturing corridors tied into the Shanghai Gold Exchange ecosystem, suggest a supply chain seizure. The claim is simple and terrifying. Major wholesalers and manufacturers in a key hub have gone roughly half a month without receiving any silver inventory from Shanghai. 15 days, orders placed, cash wired, metal not delivered. Now, I want to be disciplined here. Reports are not court-verified facts. But in investigative finance, you don't wait for a notarized confession when the smoke is already visible. You treat these signals as stress indicators. And this stress indicator matters because it sits at the intersection of industry and bullion flow. Places like Shenzhen are not just cities, they're nodes in the global production graph. If you disrupt flow there, you don't get a local problem. You get a global tremor. When factories can't source inputs, assembly lines slow. When assembly lines slow, contracts break. When contracts break, credit breaks. And then the crisis spreads from commodities into corporate balance sheets. This is the point where shortages stop being inflation and start becoming availability. And availability crises are what break economies because you can't print atoms. A manufacturer doesn't care if silver is 115s or $200 if they can pass some cost along. What they can't survive is zero supply. If they can't secure material, they miss deliveries, they face penalties, they default, and they lose access to financing. In that environment, buyers don't negotiate. They panic. They pay anything. That's when a commodity price becomes unanchored. Now think about the geopolitical chess behind this. If China's industrial demand is pulling metal aggressively, and if domestic policy is restricting exports or tightening internal allocation, then international flows get distorted. A premium develops in one region. Arbitrage tries to close the gap by pulling supply from elsewhere. But arbitrage is not magic. It relies on available inventory and functioning logistics. If the premium works too well, it can drain visible inventories and expose how thin the float really is. And here's the darker point. When the exchange channel can't deliver, the market doesn't stop. It routes around the damage. Buyers bypass the official market and go directly to producers, refiners, and mines. They sign off-take agreements. They prepay. They lock supply years ahead. That's not just procurement. That's resource war behavior. If you want to understand what a real shortage looks like, it's not just price spikes. It's buyers changing behavior. It's pay now, deliver later. It's I'll take the ore before it's refined. It's strategic hoarding. It's governments quietly leaning on supply chains for national security priorities. That's when a commodity becomes a geopolitical asset. Now you would assume the West, seeing this, would have a clean market response. Higher spot prices, tight spreads, and dealers aggressively bidding for inventory. But that's not what's being reported. The reports in the United States are weird. They're almost upside down. We're hearing that some dealers are not bidding normally for large bars. Some are pausing purchases. Some are offering prices that look absurdly low versus the screen. And if that's true, it's not proof that silver is fake. It's proof the system is short on liquidity. This is where you need to understand the difference between wealth and liquidity, because they are not the same thing. A dealer can be rich in inventory and still be broke in cash. A dealer can have a vault full of metal and still be unable to write checks to customers who want to sell. That sounds impossible until you understand the business model. Dealers operate on working capital. They buy inventory, they sell inventory, they manage spreads, they hedge exposure in futures markets, and they rely on credit lines and cash flow timing. In a normal market, it works. In a vertical melt-up, it breaks. Here's why. When prices accelerate too fast, dealers have to pay more to restock. That drains cash. Meanwhile, the public is stampeding to buy, which sounds good, until you realize the dealer is constantly swapping cash for inventory at rapidly rising prices. They become long metal and short cash. That's fine as long as they can hedge and as long as credit is stable. But what happens when futures margins spike? What happens when the exchange raises the collateral required to hedge? Suddenly, the dealer can't short paper efficiently to lock in selling prices. Their hedging cost explodes. Their risk department freezes. Their bank gets nervous. Their line of credit gets tighter. And now, when you walk in with a 1,000-ounce bar and ask to sell, you're not just asking for a price. You're asking for immediate liquidity from a system that is already drained. So the dealer protects themselves the only way they can. They widen the spread. They lowball bids. They ration cash. They post a no bid in practice, even if not literally. That creates a bifurcated market. The screen price says one thing and the street reality says another. This is exactly what dying currencies do to markets. Trading friction explodes. Spreads blow out. The price becomes a range, not a number. And the range is determined not just by supply and demand, but by who has liquidity at that moment. So if someone offers you $90 when the screen says $115, the first instinct is panic. Is the price fake? The more accurate interpretation is uglier. Cash is scarce, and the intermediary is stressed. And this is where people make catastrophic mistakes. They trade the scarce asset for the stressed currency because an intermediary is temporarily illiquid. They confuse a liquidity freeze with a value collapse. That is how generational wealth transfers upward in crises, quietly, mechanically, and with receipts. Now stay with me, because the next piece is the most important reveal of the entire video. The stress is not just in China and not just in retail. The stress is visible in the official Western Vault data. And when you look at that ledger, you stop thinking in terms of opinions and start thinking in terms of depletion math. According to delivery reports being discussed for January, we're seeing unusually heavy physical demand through COMEX mechanisms in what is typically a quieter period. January is not usually the main event. The big delivery months matter more. But what matters here is the pattern. Elevated deliveries in an off month suggests urgency. It suggests participants are pulling metal forward instead of waiting. And in commodities, pulling demand forward is what happens when trust in future availability deteriorates. Let's translate how COMEX inventories work in plain English. COMEX warehouses report categories. Eligible generally means metal meets specifications and is stored in approved vaults, but it's not necessarily for sale. It's owned by someone. Registered generally refers to metal that is available for delivery against futures contracts. It's closer to the functional float of deliverable supply. When registered inventories drain, the market can still claim there's plenty of silver because eligible exists. But eligible is not a communal pool. It's private property, and in a crisis, private owners tend to become less willing sellers, not more. That's why effective empty is a real concept. Not 0 ounces, just zero willingness. Now the reports suggest tens of millions of ounces delivered in a compressed time frame. If those numbers are even directionally accurate, the question becomes simple. What happens when the next major delivery month arrives and the system is already running on fumes? Because that's the moment the paper market meets the physical constraint. And if the constraint is real, the exchange has two choices: source metal at any price, or cash settle and risk a credibility event. That is not drama, that is market structure. And you'll notice something else in these reports: the names. When large banks appear as significant stoppers or issuers in delivery notices, it tells you this is not retail noise. Retail can't move that volume through delivery channels. That's institutional behavior. That's either clients demanding metal or banks managing their own exposure, or both. This is where systemic risk begins. Banks are not charities. They manage balance sheet risk. If they are forced to interact with physical delivery in an unusual way, it means the derivatives complex is under stress. And when derivatives are under stress, the problem spreads beyond metals into collateral markets, prime brokerage, and the broader credit system. Now, right about here, some of you are thinking, okay, but markets always look scary when they move fast. True. Which is why I'm going to give you a psychological marker, not as a trading signal, as a sentiment diagnostic. A major TV personality reportedly tweeted that silver's move is ridiculous, warned parabolic moves end in tears, and talked about selling. Now, I'm not here to build theology around one media figure, but sentiment markers matter. When loud mainstream voices mock a rally or call for selling while structural data shows depletion stress, it often signals disbelief is still dominant. And markets don't usually end in disbelief. They end in euphoria. The most dangerous phase is not when people are skeptical. It's when the public finally gives up and panic buys at any price. That's when volatility becomes lethal. That's when policymakers react. That's when exchanges change rules. That's when you see emergency margin hikes, position limits, and stability measures that are really just rationing mechanisms. So if you're looking for where we are in the psychological cycle, ask yourself this: are your neighbors bragging about buying silver? Are your coworkers taking loans to buy metals? Is the public euphoric? Or is the public still calling it a scam while institutions quietly pull supply? Because that distinction determines whether we're near the end or near the ignition. Now let's talk about the whales, because whales don't trade narratives. They trade constraints. When large, sophisticated capital allocators move from buying metal to buying mines, they are telling you something. They are saying, we don't just want exposure to spot price. We want embedded optionality on supply. They're saying, if the system has a delivery problem, the most valuable asset is not the claim on metal. It's the source of metal. Mining equities are not safer than bullion. They carry geopolitical risk, operational risk, cost inflation risk, permitting risk, nationalization risk. But they are a levered expression of scarcity when the underlying commodity is constrained. And in a true shortage, that leverage can be extreme. This is also where geopolitics turns into finance. When commodities become strategic, governments intervene. They subsidize. They restrict exports. They pressure companies. They classify materials as critical. They rewrite rules. That's why owning the ground can become more valuable than owning the currency, because the ground is not printable. Now I want to open another loop and then close it because it's central to understanding today's everything rally. You're also seeing capital rotate, not just within traditional markets, but across the entire concept of what constitutes hard money. When faith in the monetary regime erodes, people search for lifeboats. For years, digital assets marketed themselves as a lifeboat. Sometimes they behave like one. Sometimes they behave like high beta risk assets that collapse when liquidity tightens. In a true systemic stress environment, the question becomes brutally practical. What holds value when intermediaries fail? What holds value when access is restricted? What holds value when the power is metaphorically out, meaning the system of trust is offline? That's why you can see a rotation where some capital flows back toward physical assets and the infrastructure that produces them, not because technology is bad, but because counterparty risk becomes the dominant variable. And now we get to the verdict, and I'm going to keep it direct because you don't need poetry, you need operational clarity. We are living in a bipolar market. On one side, the paper reality is euphoric, indexes at record highs, headlines cheering, politicians taking credit. On the other side, the physical reality is strained. Reports of supply interruptions, evidence of spread blowouts, dealers rationing cash, unusual delivery behavior, and growing incentives for buyers to bypass official channels. That split is not normal. It is exactly what markets look like when a currency is being repriced and the real economy is colliding with financialization. So what do you do with this? First, stop using nominal numbers as proof of wealth. If your portfolio is up 20%, but your cost of living is up 20%, and your taxes are up, and your insurance is up, and your financing costs are up, you are not richer. You are running in place. In a crack-up boom, the scoreboard lies. Second, understand liquidity versus value. If dealers are lowballing bids, that is not automatically a signal your asset is worthless. It can be a signal the intermediary is stressed and cash is scarce. In those moments, the person who can wait often wins. The person who panics often donates. Third, if you must transact strategically. Know the difference between retail products and industrial bars. Know that different forms have different bid-ask dynamics under stress. Know that spreads can become punitive. And know that in a disorderly market, you don't want to be forced into a decision. Forced decisions are where wealth transfers. Fourth, watch the right indicators, not the loudest headlines. Watch physical premiums relative to spot. Watch delivery volumes and inventory categories. Watch margin requirement changes. Watch lease rates and signs of tightness in funding markets. Watch whether spreads normalize or widen further. Those are the stress gauges. Finally, and this is the part that will make some people angry, don't outsource your thinking to political tweets or televised theatrics. In a regime shift, messaging becomes propaganda. Everyone wants you calm. Everyone wants you spending. Everyone wants you leveraged and compliant. Your fiduciary duty is to yourself and your family, not to a narrative. If this really is the transition away from a stable dollar standard into a harder asset world, it will not feel clean. It will feel chaotic. There will be days where prices are sky high and liquidity is bone dry. There will be moments where you are rich on a screen and stuck in reality. That is not an accident. That is what happens when trust breaks. And I'll leave you with the simplest line in finance, because it's the line everything else reduces to when systems fracture. Paper is infinite. Real assets are finite. When the market finally decides to price that difference honestly, it doesn't do it gently. It does it violently. And it does it in a way that punishes anyone who waits for permission to see what's right in front of them.